Hi, everyone. Welcome back to the Weekend Charts, where I run through the most important charts and themes in markets and investing. Another big show for you this week. A lot to talk about. There's a lot going on in the markets, the economy. We have the Fed announcement, of course. So we're going to discuss all of that and much more. Let's start talking about the markets. A good start to the year for the S&P 500. 21 trading days into the year, S&P's up over 7%. That's the best start that we've seen since 2019. And before that, you have to go all the way back to 1987 to find a better start than we've had so far this year. And really, what a difference a year makes, right? If we look at 2022, the first 21 trading days, that market was down 5%, and it was one of the worst starts that we saw. And here, a very different picture. And really, it's a very different story to what happened in early 2022 versus what's happening this year. Early 2022, sentiment is extremely bullish. You had a few years of enormous increases for the stock market. Economy is doing well. Everybody seems to be positive and optimistic. We enter this year, really opposite scenario. We have the markets having their worst year in 2022 since 2008. A lot of bearish sentiment persisting for months. Consumer sentiment is really low. Everybody's worried about recession. And so what we have here is what the market often does, which is it causes the most pain to the most participants. And the pain trade was clearly higher here. Everybody positioned for further downside. And the market, of course, has this significant rally. And if we look at the asset class picture, it's really been a rising tide that's lifted all boats. So in January of this year, we saw every single major asset class in the green here. Very different picture than what we saw in 2022 with almost everything moving lower. And importantly, we're seeing a reversal of 2022, where the worst performing asset classes, things like crypto and Bitcoin and high growth tech stocks, the NASDAQ 100, really outperforming so far this year. Real estate in that category as well. So a mean reversion from what we saw last year so far this year. And we've seen not just stocks moving higher, but bonds as well. If we look at long duration treasuries, they're up 7.6% in January. That's better than the performance of the S&P 500. And what we're seeing there is simply long-term rates moving lower. And the optimism is kind of shared in both the bond and the stock market. So the bond market moving higher, of course, interest rates are lower. Stock market moving higher because of the expectation that the Fed is almost done hiking rates. Inflation moving down fast. That seems to be the narrative so far. We'll see if that holds. But in terms of the high growth stocks, this is an interesting picture. Last year, worst year for high growth stocks. You really have to go back to 2008 to find declines this large. And thus far this year, pretty good snapback rally. So things like Tesla up over 40%, many names up over 20% or 30% in just a 1 month period. So significant mean reversion here, where these things were so stretched to the downside, a lot of negativity. All of the fundamental data obviously was terrible, and perhaps it was stretched too much to the downside. And we're just seeing a snapback rally, or perhaps maybe that was the low. We'll only know the answer to that in hindsight. But in terms of what's going to happen going forward, I wanted to really gauge sentiment and see where we're at here, and ask this question: what will the S&P hit first? Either a new all-time high, so above the high from early 2022, or below that bear market low that we hit in October of last year. And I've done this poll a few times in recent months. This is the closest that I've seen to 50-50 between the two, but still more skeptics than optimists, still more people believing that this is just another bear market rally and we're going to hit another lower low at some point before we hit a new high. And I think if you ask most people, why do you think we're headed lower in the markets? I think a lot of people, their number one answer would be earnings. So let's talk about earnings and the earnings recession that has really continued with the fourth quarter data pouring in still. And now we have a 20% year over year decline. That's the biggest decline we've seen since 2020, and 3 straight quarters now of negative year over year growth. So from an earnings standpoint, this is a recession. Earnings are moving down versus the prior year. And the primary reason seems to be margin compression. So companies are being hit with higher inflation. Their costs are going up dramatically. Their sales are starting to slow also in 2022, and they can't push those higher costs onto the consumer. They can't continue to do that in the same rate they did in 2021, and therefore they're taking a hit to their margins. Earnings are coming down. If we look at that sales number, we're seeing definitely deceleration in the growth rate, but at 6.4%, still pretty good. In most periods, you would say, well, that type of growth rate's a little bit even above average. The problem, of course, is that this isn't a typical environment because you had inflation so high during that period of time. If you look at Q4 inflation, over 7% in terms of CPI versus the prior year. So if we change this chart, we adjust for higher inflation, you actually have a negative real sales growth over last year. So certainly a different picture and something that investors are concerned about continuing in the future. If we look at earnings, there's this saying that earnings drive stock prices. And if you look at a long-term chart of the S&P 500 earnings, they seem to be very correlated. They tend to both move higher over time, and they seem to be tied at the hip, one and the same. But if you dig into the data and you look at annual changes in earnings and the S&P 500, what you'll find is just enormous differences in the changes from year to year. So just because earnings are down doesn't mean stock prices will be down, and vice versa. And the magnitude of the changes are not nearly the same. And we saw that again in 2022, but we've seen this pretty much every year where it's very rare that earnings and stock prices are both moving the same amount. And so what the result of that is that you have this multiple expansion and contraction, and what's driving that is investor sentiment. So what investors will pay for a given level of earnings is the most important factor. Unfortunately, it's a factor that's almost impossible to predict, and therefore all of the forecasts you hear about where the S&P 500 is going to end this year, just throw them out the window, because none of these people can predict where the multiple is going to end up. Even if they're able to predict earnings, and no one's been shown the ability to do that, but let's say they could predict where earnings are going to end the year. Let's say they're right and earnings go up 10% this year. They still have to predict what investors will pay for that, and that's an impossible task. But where we are in terms of the PE ratio, it contracted by 15% last year, so 19.3. They're just below the historical average since 1989, which is around 19.6. So pretty close to that at year end 2022. Where is the multiple going to end 2023? No idea. We've seen as high of a multiple as 30.7 at the end of 2020 and as low as 13 in 2011. So this is data going back to 1989. And of course, if we're at 13 or we're at 30, over 30, that's going to make all the difference in terms of where the S&P 500 ends the year, regardless of what happens to earnings. So very difficult game to play. Don't trust any prediction, because no one can predict this column here what investors are willing to pay for a future level of earnings. So why are investors concerned about growth rates slowing? Well, they're looking at really a lot of the bellwethers, the tech sector, and they're seeing just widespread growth, slowdown in growth. And that's been going on for a few quarters, but it really in Q4 accelerated. We're seeing Microsoft's revenue growth up only 2% year over year. That's the slowest growth rate since 2017. And a lot of this is simply a reversion to the mean. Microsoft had tremendous growth for a company its size in recent years. Its revenues more than doubled since 2017. It's just an incredible rise in recent years, and the company's enormous. And so how can it maintain this level of growth forever? Looking at double-digit or 20% growth rates, you can't maintain that forever. And as we talked about, the slowdown in the economy is a factor as well, but also just a mean reversion in terms of growth was pulled forward for many tech and software companies during the pandemic. And now you're seeing the other side of that with versus higher comps from last year. So slowdown in Microsoft. Microsoft's not alone. We talked about Netflix last week. We also have Facebook here. now down 3 consecutive quarters year over year of negative growth. We have Intel down 32% in terms of its revenues. That's the largest year over year decline in Intel's revenues in the company's history. So pretty much all companies showing slower year over year growth rates. Intel's a really fascinating example. I put out this chart showing Intel's total return price. So this includes dividends going back in time. You can see two really interesting periods here. One would be the 1990s peak, and then the more recent run up to the 2021 peak. But interestingly, Intel's price today is actually 39% below its 2000 peak, and that includes dividend payment. So you can go a long period of time investing in a stock and lose money and underperform the index. If we showed the S&P 500, S&P 500's more than quadrupled since this 2000 peak. So very different story for Intel. Very hard to pick stocks in the long run that will be persistent winners. The leaders are always changing. During the 1990s, Intel definitely one of the best stocks ever during that decade. And since then, we've just seen a mean reversion. The price that you pay matters. And the price investors were paying at the 2000 peak was simply too high. It made achieving a positive return over the next 20 years difficult, not impossible, but difficult. But here we are over 20 years later, down from that peak. So a lot of lessons to be learned in this chart. But the number one lesson is the importance of diversification and not concentrating too much in one single stock. And that brings up Tesla, of course, because Tesla is the story stock of the current boom that we saw in 2020 and 2021. And Tesla, more than any other stock, has really been an investor favorite. And after 2020, that really became apparent because Tesla stock was the number one stock in the S&P 500 and by a wide margin. It went up more than 8x that year alone in 2020. And the important part of that is that its revenues only went up 28%. And so what that meant was you just had this massive increase in investor expectations, and the valuation of Tesla went from here all the way up to here, 30 times sales for a car manufacturer, just an unbelievable price to sales ratio. And what I wrote at the time about Tesla was that this is a great company, clearly. This is a company that's growing very fast, but even if they execute on everything in the future perfectly well, it's going to be difficult for investors because it's going to be nearly impossible to maintain this level of optimism. And if that multiple comes down in the future, you're going to see shares very quickly reprice. Now, that's, of course, what's happened. Tesla's actually executed unbelievably well since its price to sales ratio peaked, still growing at a very rapid clip, but the price to sales ratio came down to 5 after an over 70% decline for Tesla. And what's going on there is investors are expecting slower growth going forward, and they revalued the stock price because of that. So interesting thing, another interesting thing about Tesla, and it's an important lesson to be learned here, is its story of its net income. You have negative net income, so losses for Tesla every year from 2007 through 2019. And then in the last few years, just a huge flip to the positive side. You had net income in 2022 more than doubling versus 2021, made 18.8 billion in those 3 years versus 6.7 billion in losses. And so what's instructive here, a few things. Number one, it's very difficult to value a company that's losing money. And so what you heard during a lot of these years is Tesla's just insane. It doesn't make sense. Why is the price going higher? It's losing money. It's never going to make money. All sorts of things like that. And sometimes that maybe that saying that would have been correct, but not in the case of Tesla. Here, investors were obviously looking forward to profits in the future, and those profits did come. And when they came very rapidly. So when a company flips from negative to positive, also very difficult to value that company because then what is going to be the growth rate in terms of net income from there? And as we can see for Tesla, it's just been enormous. But getting back to that slowdown here. There's been no real fundamental difference in the company in terms of it's still executing, it's still selling more cars than last year. But why are investors now paying a much lower price to sales ratio? Well, this would be the reason it's been a slowdown in the rate of growth. 37% year over year, still very high. Tesla did 81.5 billion in revenues in 2022, huge increase over 2021, but not enough, right? Investors are, when you're paying 30 times sales, you're expecting increases in revenues of enormous magnitude to continue over a number of years. And now that expectation is kind of shifted, still pretty high at 8 times sales, but the expectation is more, at least more in line with its growth rate. The question for the future is going to be how fast can Tesla grow? How many years can it continue growing at that pace? And can it maintain that still elevated valuation level? So 8 times sales is still more than 4 times higher than where the S&P is trading in terms of its price to sales ratio. So Tesla's got to continue to show this enormous growth if it wants to maintain that type of valuation. So if we talk about 2020 and the 8x increase in Tesla and just the record mania that we saw into early 2021, if you're going to look at factors that cause that, I think the number one factor you have to point to was the money supply and just the ridiculous increase in the money supply that we saw during that period of time. On a 1-year basis, we saw the money supply increase 27%, highest on record. Over 2 years, we saw the money supply increase over 40%. So unbelievable flooding the system with money. That obviously one of the major factors causing inflation. Also caused people to speculate more, and this huge boom in terms of the stock market, particularly high growth stocks, and many other factors. But now we've seen a 180 degrees shift. We've been talking about this for a while now as a leading indicator of lower inflation rates to come, because now the money supply is contracting. It's actually down year over year. First time we've seen that with data going back to 1960. First time we have a down calendar year. Every single year, money supply seems to go up. This is the first year we're seeing it go down. Very different picture than 2020 and 2021. So interesting in the Fed press conference, no one mentioned the money supply in terms of why the inflation rate is moving lower. It's interestingly, they didn't mention it on the way up as well. It's something that seems to be totally ignored when it comes to the Fed and people asking questions of the Fed. But it's a major factor for sure, and it's likely to portend lower inflation rates still to come if it continues in this direction. So we keep getting these additional signs of lower inflation. PCE price index was put out, and 5% increase is the lowest since September 2021. This is something that the Fed looks at pretty closely, so important gauge of inflation. It peaked at 7% last June. And then if we talk about housing, which is by far the single most important component of CPI, a third of the index, we see continued declines in the rate of change, rents declining again in January. The rate of change in terms of rental increases now only 3% increase year over year. So very different picture than what we saw here on the way up in 2021. So rental inflation, actual rental inflation going down in terms of the rate of change. And why is the CPI still showing shelter increasing in terms of a year over year basis? Well, it's a lagging indicator. So if this trend continues, I suspect by the middle of the year at least, you're going to see this reflected in CPI shelter, and that'll start moving lower. And when it does, it's going to be a huge factor, bringing the CPI even lower than it's going because of how important housing is to the index. So it's not just rents though that are moving lower on a rate of change basis. If we look at home prices in the U.S., the Case-Shiller index came out. This is as of November, so it's a little bit lagging data, but still a rapid deceleration in the increases in home prices. If we look at the real-time data, it's actually even less. So 7.7% increase for the Case-Shiller. But Redfid's data shows median sales price over the last 4 weeks, and that's up only 1% year over year. So home prices, our growth rate is coming down pretty rapidly. If home prices kind of stay stagnant here, very, very quickly, we're going to see prices go down on a year over year basis because we saw prices peak last June. So, unless we see a run up again in the coming months, which I don't think a lot of people are expecting, given the affordability picture, we're going to start to see this tailwind for the CPI start to be a headwind, and a good headwind, because you want to see housing costs come down, because it's simply the affordability level is still a real major problem. And if we look at the uh, 20 city index, we're seeing every major city down off of its high, San Francisco being the worst, down over 11% from its high, and actually down year over year. This is the first city in the index to turn negative on a year over year basis since 2019. So, trend flipping in the opposite direction. I think that in the next few months, you're going to see more cities go negative on a year over year basis. And again, the driver is simply affordability, the lack thereof. The mortgage rate more than doubled over the last few years, and you have home prices up 40% over that period of time, simply made the average house unaffordable to the average household. And you could get to more a better affordability picture in two ways. One, you could have mortgage rate come back down, but two, much quicker way would be to have prices come down, and that's really a more long-lasting solution to this problem because of how rapidly prices went up. 40% increase in 2 years is just an unbelievable increase, and needless to say, people's incomes have not gone up nearly that much. So, housing is going to be an important thing to watch for this entire year, in terms of not just the prices of housing, but activity there as well, as it was a pretty big drag to the economy last year. If we talk about inflation, we're seeing many things go lower in terms of the inflation rate. One area we're not seeing moving lower is the price of eggs. And this is something everybody's talking about because there aren't many things in the supermarket where you probably know the price of, but eggs are certainly something that people seem to know the price and compare the price to previous time periods. And the average price of a dozen eggs in the U.S., the increase is over 100% in the last year. That's by far the biggest increase we've ever seen, with data going back to 1980. And people are wondering, well, why is this the case? Is this price gouging? And really, it's really a supply and demand issue, with supply being the major factor. So we have 57 million birds dying of bird flu over this period of time. That's a huge shock to supply. I think I saw a number saying that there was about 300 million chickens. So this is just taking out 57 million of them is going to increase the price of eggs significantly, and that's exactly what's happened. And is this going to stay at this level? Maybe in the short term, yes, but I suspect if we look out a year or two from now, we're going to see the price come back down to reality. So supply and demand are going to dictate that, and as soon as supply starts to catch up again from this, unless there's another bird flu epidemic, you're going to see the price of eggs come back down. And so, don't believe the people who say this is going to stay up forever, ever. We saw this with many different commodities and prices of things over the last year or two. Once supply and demand start to work their magic, you're going to see the price come down. But what are people thinking of doing in response to this? This is a funny thing. Saw a lot of headlines of this. A lot of people talking about buying chickens and raising chickens to combat that price increase. Is this going to work out well for most people? From a saving standpoint, I don't think so. It's pretty hard to beat, even at $4 for a dozen eggs, $5, even $6. It's pretty hard to beat that price from a time standpoint, from a cost standpoint. If you had to buy chickens, feed them, and build housing for them, and all the rest of that cost of that, you're unlikely to come out ahead in terms of the time, effort, and expense versus paying $4 for a dozen of eggs every week. So I think it's certainly an idea that people are thinking about, but I wouldn't do it to save money. Maybe you do it because it's a fun activity for you and the family. But to simply think we're all gonna become farmers, and that's going to combat the cost. I don't think that's going to work out. I think that what you're going to see is that this price is going to come back down, and people are going to stop talking about that. And perhaps a few months, we're already seeing wholesale prices of eggs start to move down, and that's obviously a leading indicator of retail pricing. So perhaps we're already at the peak of eggs, and we're going to come down from here, hopefully. But in the meantime, it's going to be something people continue to talk about. So let's shift gears and talk about the positive side of inflation, and who could inflation possibly be good for? Well, there's one group that actually benefits from higher inflation, and that would be debtors, people that owe money, and there's no bigger debtor out there than the U.S. government. And so, why is inflation good for debtors? Well, they're paying that debt back now with money that's been devalued. So you're paying that money back, paying that debt back with money that's worth less, and that's actually makes it easier to pay it back. And so inflation is one way out of a debt problem. It's not particularly the best way because there's other obviously problems associated with inflation, but it is one way. And interestingly, even though the U.S. national debt continued to increase in 2021 and 2022, we saw the debt to GDP ratio actually move down. The big reason for that is just that inflationary picture pushing up nominal GDP more than the increase in debt. And for those people out there that are concerned about a default in debt, I like to always go to our friend Alan Greenspan, Fed chairman, and his quote, because it's really it rings true in terms of you shouldn't fear that the U.S. Is going to default on the debt, because the United States can pay any debt it has, because we can always print money to do that. So there's a zero probability of default. It's absolutely true. In the extreme, the U.S. can go out tomorrow and print $31 trillion, pay back its debtors, and have zero debt. They're not going to do that, obviously, because that's going to cause a lot of problems. That money then is going to become essentially worthless, and inflation is going to be rampant and all the rest of it. But theoretically, they could do that, and therefore the U.S. is unlikely to ever default on their debt. It could, because they control the printing press. They could always print money if they wanted to. And so if we talk about this concept of easy money, and certainly money has been easy in recent years, and really since the end of 2008, this is a kind of a sea change what we've seen here with that last Fed interest rate hike. So the Fed, as expected, everybody pretty much knew it. There was almost 100% probability heading to the meeting. And the Fed did what the market expected it to do, which is it's done in every meeting over the last decade. And they hiked 25 basis points. So now we have the Fed funds rate, interestingly, 4.5% on the lower end, which is now above the rate of core PCE inflation, which is the Fed's preferred measure of inflation, for the first time since 2019. So I like to look at these two together to say, is monetary policy restrictive or is it loose? To me, when the Fed funds rate is above the rate of core inflation, then you finally have a restrictive monetary policy. And now we're finally there. The Fed, of course, was so far behind the curve here in not raising the Fed funds rate, but they've made up for that in a rapid increase in the Fed funds rate over the past year. Now, since 2008, since the Fed cut to zero in 2008, the Fed funds rate has only been above core PCE one other time, and that would be a short period from 2018 to 2019. So we've had this long, really era of easy money. But if you went back in time, before that post 08 period, it wasn't uncommon to have the Fed funds rate not only above the rate of inflation, but well above it. So we saw that in the 1990s, the 2000s. It was kind of common that the Fed would keep the Fed funds rate at a level somewhat above the rate of inflation. But that thinking changed after 2008. The thinking was, well, there's no downside. Why don't we just have easy money? The Fed kept interest rates at 0% from the end of 2008 to the end of 2015. and they very slowly increased it from there. And when they finally got above it here in 2018, they didn't keep it there very long. In 2019, they start cutting rates again, bringing that Fed funds rate back below the rate of inflation. They reinitiated quantitative easing. And then when the pandemic hit in 2020, we go back to zero. We do a massive QE. So the question this time around will be, what is the Fed going to do? Are they going to do similar to what they did over here? They keep it above it for a short period of time, and then they start cutting rates again, doing more QE? Or is it going to be like we saw in prior economic cycles, where we have a longer period where the Fed funds rate is above inflation? So I think the market is saying to some extent that Fed funds rate up here is not going to last very long. Markets predicting the Fed will hike one more time, so they'll hike in March, but then that's it. And they're going to start cutting rates in November or December of this year and continue to cut rates throughout all of 2024. And interestingly, at the press conference this time around, Powell didn't really dismiss that. The last press conference, when people were asking Powell about the market's expectation for rate cuts, he essentially said, no, that's not what we're thinking about at all. People shouldn't be thinking about that. We're still going to be tightening, and so throw that out. But this time around, he kind of said it's a possibility. He said that the market is clearly expecting much lower rates of inflation than we are, and if that were to happen, we're not going to rule out that we wouldn't cut rates. And the market seemed to love that comment. S&P really took off after he said that. And so the expectation for markets is that won't stay up here, won't be like the 90s or 2000s, where the Fed funds rate can stay elevated for a period of time. Markets thinking Fed's going to do what it's done more in recent years, which is cut rates as soon as it's palatable to do so. So a lot of that's going to depend on the trajectory of the economy, trajectory of the inflation rate. So all of that we don't really know. But if it goes down as expected in the next few months, the Fed's likely to stop or pause it for a period of time before doing anything. And then the question will be, is the next move after that going to be hiking versus cutting? The market's saying it's going to be cut because inflation is not going to be a problem, and perhaps the economy is going to be more of a problem. And on that point, a lot of people have been wondering, is there going to be an official recession this year? An official announcement. I did a poll in January asking that question. 64% of people said yes. There's going to be an official recession declared by the NBER, who is the official arbiter of recessions in the U.S. But after we got the GDP report, I think those people are going to have to wait a little bit. What we saw was another new high in terms of real GDP. And so that's 2 quarters in a row of a new high in GDP, and it kind of erased the losses from Q1 and Q2. So remember, we had those consecutive negative quarters in Q1 and Q2 of last year. No recession was declared by the NBER. It doesn't seem likely now that they're going to do that, given that there's some time has passed since then. And so we have the real GDP in the U.S. starting to slow here down to 1%, but no, of course, declaration of recession. The question becomes leading indicators. Why are all these leading indicators flashing the same thing, which is a warning? And is this going to be another scenario where they end up being correct? So we have the conference board here, leading economic index, 6-month growth rate in territory where in the past we saw recessions in 2001, 2008, and again here in 2020. So we're going to see something similar in the next year. And a big leading indicator that we continue to talk about will be the yield curve. So the yield curve suggesting that there's going to be economic weakness ahead. Most inverted curve that we've seen in the 10s versus 1 years. You got to go back to September 1981. That was another recessionary period. And so the question is the economy going to be in an official recession at some point this year? And I think a big driver of that is going to be the U.S. consumer. Biggest part of the U.S. economy is the U.S. consumer and consumer spending, of course. And this chart is, I think, at some point going to be an issue for the U.S. consumer. It's showing you that credit card interest rates are just skyrocketing here, up to over 19%. We started 2022 at 14.5%. So just a significant increase in a very short period of time. And will the consumer start to pull back because of this? Either they're paying more in interest, so they can't spend more, or they get nervous about borrowing more because rates are so high, or credit card companies themselves won't issue that new debt to these consumers because of their balances are growing. And many people carry a balance on their credit card, so this is going to impact a lot of people. And what we saw in the last year was that credit card debt really skyrocketed. So we've talked about this, but I want to cover it again. One of the reasons people were able to maintain their spending despite higher prices, higher inflation outpacing their wages, was that they took on more debt. So they filled that gap with debt. They also saved less. And I think that in 2023, when this starts to turn and cause a problem, that's when you're going to see real economic weakness. And maybe it gets deferred and maybe the interest rate comes down. And of course, if the Fed starts cutting rates again, that'll change this picture. But I don't think that interest rates going up this much, this fast, is going to have no impact on the consumer or the economy. We're not just seeing it in credit cards. If you look at auto loans, obviously we've already talked about mortgages. It's pretty much everywhere that the consumer relies on to purchase goods. The interest rates on that has gone up, and that's going to hit at some point, really hit demand. We've already seen it in housing. We're seeing it in certainly in used cars, but we're going to see it in other areas as well, I think, if it persists. So big question for the U.S. economy: when will the consumer start to pull back? If we talk about the oil market, the Strategic Petroleum Reserve has gotten a lot of attention over the past year, and that's because we're tapping it at a rate like we've never done before. 71 consecutive weekly declines in that Strategic Petroleum Reserve. It was at its lowest level since 1983. But that seems to be over now. In the last 2 weeks, we've seen no change in the petroleum reserve, so no selling. It's unchanged. They're not buying either so far, and that really marks an end to this trend. And this is interesting to me because a lot of people credited this decline in the reserves with the decline in gas prices. So if you listen to politicians, they'll say, well, the gas prices went down because of the decline in the strategic petroleum reserves. We did that essentially. And if you look at the data, it's unlikely that that was the case. Optically, it seems pretty good, but it's a case of mistaking correlation with causation, I think, because as we've talked about, the sales from the Strategic Petroleum Reserve only added less than 1% to the global supply of crude oil. And crude oil is a global market. It's not just a U.S. market. It's a global market. So the price you're paying at the pump is a reflection of global prices of crude oil. And selling crude oil from this reserve and increasing the supply by less than 1%, not likely to have a significant increase on prices. So we saw gas prices peak last June. They came down. Why did they come down? Supply and demand. There was less demand, more supply. The slowdown in the economies, particularly in China, had a big impact on that. In reality, the Strategic Petroleum Reserve changes have almost no impact on it, but optically, it seems like that's the case. Now, what's going on with gas prices right now? They're trending up over the last month a little bit. So now higher again on a year-over-year basis, but still well off where we were last June at the peak at over $5 a gallon. So hopefully they can hold the line here and we see gas prices move sideways or even move down. And then if that happens sometime at the end of February, early March, we're going to see big declines on a year-over-year basis because this is when Russia invaded Ukraine last year. We just had this huge spike in gas prices, and that continued to its peak in June. And if prices just stay flat here, you're going to see this as a negative year-over-year number, and that's going to be an additional factor to pull down that inflation rate. So let's talk about diversification. This is a really important concept. And for years, people were kind of saying, dismissing diversification. I don't need diversification. I just need large cap US tech. And in particular, I need the big four: Apple, Amazon, Google, Microsoft. Why were they saying that? Because there was just tremendous outperformance from 2009 to 2021 of these four names versus the market. If you just held these four names, you would have outperformed everything by a significant margin. But in 2022, we saw a very different picture here. We had all four stocks were down on the year, and all four underperformed the S&P 500. That was the first time all four were down a year and underperformed the S&P since 2008. So very long cycle, but there's a cycle to everything. And perhaps this cycle peaked here in 2021. And perhaps now we're going to see a reversion to the mean. We're already seeing that in terms of the weighting of the biggest five holdings in the S&P 500. We hit a record high at the end of 2021 in terms of concentration. That's moved lower after last year. Apple being the single biggest stock in the S&P, its weighting was higher than any individual stock going back to 1980. That's come down after last year. And so what we've seen is the benefits of diversification really take hold in 2022, starting with this relationship between value and growth. So growth has this enormous run of outperformance the decade before 2022, in particular 2017 through 2021, 2020 being the big one here. Growth just trouncing value at its most stretched level since the 1990s tech bubble that peaked in 2000. And interestingly, 2022, we see value outperform growth by 21.6%. That's the second most of any year in history, trailing only 2000. So is that a sea change? It seems to be. Will it continue? That remains to be seen. But after the shift in 2000, what we saw is value continue to outperform for a number of years thereafter. So there's a cycle to everything. And the relationship between value and growth over time shows big swings in both directions. And we had just growth stock outperformance really stretched to the upside. And now we're seeing a mean reversion. If we look at the S&P versus an equal weight, so kind of large versus smaller or mid cap, what we saw something similar in 2022. S&P had been outperforming in the prior decade, outperforming certainly in recent years. And now we have equal weight outperforming by 6.7% in 2022. Biggest outperformance of equal weight versus the S&P cap weighted index since 2010. So perhaps another sign of a sea change, and perhaps another example of a benefit of diversification. This last one here is an important one. US versus international. International stocks have done relatively much worse over the last decade. Just extreme outperformance by US stocks. And if we look at 2018 through 2021, enormous differential in favor of US stocks every single year. That shifted a little bit in 2022. So the MSCI EFA index outperformed by 4.1%, biggest outperformance since 2009. But if we look back in history, we've seen big swings in both directions, outperformance of both. And really, we've never seen the two stretched this much in favor of US stocks, just given the huge run up they've had since 2009 versus international stocks. So is this going to continue in terms of this shift? Nobody knows. Growth versus value, large versus small, US versus international. No one can predict the future, which is why you diversify, to protect yourself against the inability to predict it. So you want to build a portfolio that's resilient, that can do well in multiple possible outcomes. And that's why, if just concentrating in any one area, it's been great for the past decade if you were in large cap US growth tech or the big four. But in the future, if those are not the leading areas of the market, you'll be happy that you have some diversification in your portfolio. So I want to end, as I like to do, with something positive. And crashes are not something that people often say are positive, but here's a few crashes that I think are very good news for everyone. Number one, natural gas continues to move lower at a rapid pace, now down 76% from its peak. And its peak level last year was the highest we saw since 2008. Had many people talking about the price of gas particularly heading into the winter. Thankfully, we've seen the price of natural gas plummet here back to 2021 levels. Great sign. Hopefully, this continues. Natural gas very important, obviously, not just for heating your homes, big input for electricity costs. So, great sign. Hopefully, it continues, or at very least stays where it is. Certainly a welcome thing to see. And then, lastly, I keep showing this chart, but I'm going to keep showing it as long as it continues to move in this direction, because it's a great thing to see. Fertilizer prices continue to move lower, over 50% below their peak from last year. And that's a great thing to see, because you tend to see a high correlation between fertilizer prices and food prices. Talked about eggs going up, but really a lot of food prices moving higher. If you look at the CPI food index, up over 10% in the last year. I suspect if this trend continues and what we're seeing in terms of agricultural prices moving lower, that's going to start to be reflected in the prices of food. And I don't think that double-digit prices in food are going to stay here for very long. You're going to see that come down significantly in the months to come. Hopefully, that's the case. So, two good crashes. You don't often like to hear the word crash. But when it comes to prices of necessities, in terms of energy prices moving lower and food prices moving lower, this is indeed a very good thing. So we'll leave it there. Thanks everyone for joining me. Have a great week. Have a great weekend. Subscribe to the channel for a lot more content like this, and I'll see you next time. Thanks.